We're back taking your questions on all matters financial at 800-321-0710. If you have questions on what's going on in the world of finance, 800-321-0710. Bill Wong, I don't know if you've heard about this, Ernesto. There was a hedge fund that nearly imploded. It did implode. And what does it mean for you? Well, it probably means there are good deals on Chinese stocks. So Yahoo Finance has an article, God and Man Collide in Bill Wong's Dueling Lives on Wall Street. Archegos says Bill Wong created wealth at a historic pace before losing it all. So basically what this guy did, and this is particularly nerve-wracking, is the guy loaned money to invest in growth stocks, and basically, it was crazy. So what he did, it was epic. So this is from Fox Business. Before his collapse this week, losing an estimated $8 billion in 10 days, hedge fund trader Bill Wong increased the size of his fortune a staggering 900% or more in just 7 years. Wow, it's crazy. For the man behind Archegos' capital management, it may be one of the fastest creations of wealth and destructions of wealth in recent history. Major banks, by the way, invested in this guy. Billions. Like Credit Suisse, others, like $2 billion. Some large bank in Japan, $1 billion. It was like crazy. And it may be one of the fastest destructions of wealth in history. But why did they destroy it? They basically used a credit card from these banks to buy high growth stocks. The Facebooks, the Amazons, the Netflix, Google. So they bought with leverage. You can buy on margin. In fact, a lot of people tell you to do that. It's kind of a bad idea because of stuff like this that can happen. So what this guy did is he just levered up. And if you borrowed money, let's say, to buy Facebook, Amazon, Netflix, Google the last 10 years, Tesla, you borrow at low rates, and this is why I think low interest rates are bad for the economy long term. You could have rich guys like Bill Wong borrow at 2 or 3% and then put in stocks that grow at, as in the case of Tesla's, 7 times its value in a year. So it's crazy. So longtime hedge fund trader was wealthy, and basically, what is the point of all this? It's crazy. So he, and you'll hear this, and apparently the guy used Christian faith too in his marketing, which I'm a believer, but I often tell people, you don't do business just on that basis. So it's crazy what happened, and there are a lot of problems with this whole thing. So this guy had a foundation, he gave away a lot of money, but if he just did the right thing for his clients and not buy everything with debt. So this was a guy who was the protege of Julian Robertson. So what do we see? We see some warnings for the average investor. I see 3 critical warnings in the life of Bill Wong that you can take advantage of. Number 1, there is a mystique in international investing. Okay, we have an Asian-focused company. Now, mind you, I am all for select Asian stocks that I think are of good value. I'm not. But this guy, he bought Asian stocks with a credit card from some of the biggest banks in the world because he was like a little god in the industry. He was the son of a Christian minister from Korea. That's tip number 2. Don't beware of affinity marketing based on religion, whether you are Christian, Jewish, Muslim. I've been taken advantage of by people of all faiths, and you might be too. So it's not a sense of which I am a deep Christian. I deeply value my faith in the Lord, but it is not the reason to do business with someone, and nor should it dissolve you of the ability to think critically. Okay, so people would say with this guy, okay, Asian focused, check. And all of this is alleged, and, we'll see what happens. But apparently $8 billion evaporated very quickly. And I don't know how that happened, but it's very easy when there's derivatives. That's the thing that Harry Dent was talking about last week. There's like 500 trillion in derivatives. People don't even understand what derivative is. It is something of a derived value. So you have $1 in, let's say, Tesla stock. There may be 10 other dollars taking bets, some betting it's going to go. So there's really no value in some of these bets that are going on. And I guess that's what he was involved in. I still don't know the whole thing other than he was buying with leverage. So tip number one, avoid the mystique of foreign investing. You could buy index funds that invest in foreign companies. You could buy the real company. You don't need to take loans out to buy it. So avoid the mystique of investing. Know what you're investing. Number two, avoid affinity marketing scams. And number three tip, it was going to be good. Avoid leverage. Now, I'm all for safe, positive leverage. So people say, well, why do you think you should have a 30-year fixed mortgage? Because that to me is safe, positive leverage. You're not going to have a bank call the loan. Obviously, the banks called the guy's loan and said, we've lost enough here. We're calling the loan. You say, well, how did he lose $8 billion? Because he had to cover the loan. They covered with the cash they had. They didn't have the cash they said they'd have. So you know what? And that leads us to tip number 4. Boring is okay. Like, I don't know about you, but I didn't come from much of any money. I'm okay if I have a house and some assets, and I can pay off my debts if I want to with what I call safe positive leverage, SPL, because I have a home mortgage. Worst that happens is they take my home, I guess. But my interest rate is, let's say, 2.5% for 30 years fixed. The bank is not going to call my loan unless I do not pay. So people say, well, could a Harry Dent type situation happen? I want to be clear. I'm not promoting fear like Dent in any way, but it could happen because this guy lost like $8 billion in like a span of a week. And that's due to derived trades called derivatives. So the tale of Bill Wong says, and also don't trust people just because they're billionaires. They're dumb too. So just because somebody has a lot of money doesn't mean they're necessarily smart. So go ahead. I mean, think about how dumb that is. You got a guy who was wealthy in 2006. He was wealthy in 2010. But it wasn't enough. He had to lever to the hilt. And even the concept of leverage is good, but he didn't have cash. So what happens is these rich people scam each other, or not intentionally, but it's like, well, this guy has great returns of 90% a year. Well, warning sounds like Madoff. Now this guy didn't do any Madoff-like things. He just was financially irresponsible. So go ahead, Jack. Go ahead. You're on with Josh Jalinski, the financial quarterback, calling us. So we have two lines, 800-321-0710. Go ahead, Jack.
Hi, Josh. I listened to your show last week, but I listened to it on Monday on the podcast. So as the Archegos hedge fund was imploding, and that got me a little worried because Harry Dent was talking about possibility of a severe correction coming on. So I figured maybe you, in light of that,
this has nothing to do with this has nothing to do with that. Like, one doesn't equal the other. Be clear here. Harry Dent came on the show in 2015, 2016. He said if he was wrong about the market, he would become a cab driver in New York. He's now sipping pina coladas on the beach in Puerto Rico.
Right.
So you got to realize, be careful of the mystique. That's another tip of the guru. Harry Dent is, we respect all of our people. He is right in this regard. Wealth could evaporate very quickly in the next downturn because of low interest rates and massive bets. So he is absolutely right on that when this ship is going down, it's going down hard. But the Fed knows that. So they're trying to keep rates artificially low so we don't have a Bill Wong a week. So I don't think Bill Wong is like the canary in the coal mine. He could be, but I don't think one fund is the problem. I think there is systemic risk in the stock market, and Harry is right about that you have to be cautious with your own money. And he does a great job of waking people from their slumbers on a Saturday morning. Very lively guest. But that being said, don't live your life on fear. But if you have 100% of your money in Facebook, Amazon, Netflix, Google, there's a problem. There's a problem if, your wealth was created due to Tesla's epic rise of the last year, which, by the way, is because people think Tesla is investing in Starlink. And no, Starlink's a different company. So they think, and what happens when every other company has an EV? What happens when, so there are some issues I have with the general population. So I hope that helps you. Any other questions on that?
Well, my issue, what I see is this is now the third hedge fund that has imploded in the last, in 6 months, let's say. And then what I saw occurring was that because of this implosion, he was forced to sell numerous regular everyday stocks, put them onto the market, which led to an effect of those companies going down in stock value. So it's kind of like a ripple. It's even though he owns stocks in legitimate companies that now got reduced because he had to do these large block trades. And that's concerning.
Yeah, but that means they're good deals. And that should concern you. But how much of your nest egg is tied up in the market right now?
No, I'm not 100%. I would never do that.
Are you 50%? Are you 60? Are you 80? What is
Probably
your
I keep about, I would say, almost 40% in cash. But the problem is that or something.
Your 60 could go to 30. Yeah, that's the problem. And that's true. It's where we are at the market. I think if I was a betting person, although you should not take anything anyone says as a reason to sell based on what year, I, for some reason, think we're in '07. In '07, there were warning signs. There were some banks going under. And I think that's what it is. It's like a warning sign for the watchers. But you might have a year and a half of some really good times in the market too. So banks lost a ton of money. Credit Suisse slid 14%. Nomura lost 16%. That's Archegos. You also got to realize too, if you're watching CNBC, they are trying to get watchers, and nothing generates the buzz like fear. So you have to be careful of that. But no, you're right. Derivatives are a problem. So be careful. Also see who owns what. And are you a long-term investor or are you short-term? You really should be a long-term investor. Up next, we'll take your calls. But first, call us for the free retirement reality strategy session today, and you get my free guide, how to navigate one of the biggest changes to your IRAs. Taxes are going up. Are you prepared? My clients are. Call us at 888-988-JOSH. We'll be back after these messages. Hi, we're back. This is Josh Jalinski, the financial quarterback. Ernesto said an interesting comment. He thinks a lot of legislation will come out as a result of these failures. I agree, but they won't do anything. They're going to be like, we're going to impede growth. That's why if interest rates were higher, interest rates right now might be 5 to 8%. Because think of it this way. Your money is your hard-earned dollar. How quickly would you part with it if you could put it at the bank and make 5% or 8%? And that's where I think rates should be relative to the risk. So the reason why we have a Melvin Capital or a GameStop or a Bill Wong is, and I'm livid of people who do these types of things. We all are. But it wasn't, in some sense, he was taking advantage of low interest rates and exploiting leverage. So what you do is you make interest rates more costly. You don't artificially hold them down. Because then somebody would say, Bill, prove yourself. Don't just make me money because you're gambling based on low interest rates staying low forever. By the way, there's a lot more like that. A lot of municipal bond funds that do that. Municipal bond hedge funds where they're playing off the low interest rates. And there's nothing particularly wrong with that. They're trying to get extra yield for their clients. But the problem is when things go wrong, they go really wrong. Next up, Maria. Go ahead. You're on with Josh Jalinski, the financial quarterback.
Yes.
Turn down your radio. Turn down Maria until she turns down the radio. You have to behave, Maria, okay?
Yes, thank you.
No, I'm hearing myself again. Maria, we'll have you back on when you can prove to our call screener that you've shut off the radio. So, folks, are you prepared for retirement? Call us right now for the 45-minute strategy session. What are you waiting for? Look at the funds. We will, if you call us today, 888-988-JOSH, we will throw in the 2-for-1 special. You will get a free consult with an estate planner. And today is one of your rare opportunities before they pass the new Biden tax plan. We had the Trump tax code. Now we're going to have the Biden tax plan. Who would have ever thought that President Biden would have been so consequential? Think about the stuff that every day they're passing things. So what do? Well, you actualize the plan. So there's probably going to be an infrastructure bill. There's probably going to be a tax hike. You do not go it alone. You set up things to prepare. You don't just put your head in the sand. I used to say this commercial, don't put in your head in the sand like an ostrich. And then somebody yelled at me and said, ostriches don't put their heads in the sand. I don't know if that's true or not, but I got a lot of flack for that. So I'm sorry if it's still running. I'll tell them to take the commercial down. So I thought it was a good commercial. It was like, don't put your head in the sand like an ostrich, because you want to just put your head in the sand. Like every day you read, the news gets worse. That's the other thing. I don't know about you. I've stopped watching as much news. It's just depressing. And folks, give us a call, 888-988-JOSH, if you have a financial question for us. 888-988-JOSH. So we have in the Biden tax proposal, the death tax is going to come back with a vengeance. The federal exemption will be lowered. Making gifts will be lowered. I didn't know they were proposing $1 million. I don't think that's going to happen. I think that's one of like a negotiation ploy. Like we're going to make it $1 million to $3 million, so we settle on $6 million. Because it's easier to tax dead people. But here's the thing. If you're a billionaire, there is some point, I may get flack from this, from our conservative audience. There's some point in which Elizabeth Warren, of all people, is right. Because if you have a Jeff Bezos or Mackenzie Bezos, they take their money, they buy assets because they're smart, that throws off income. And then they give money to charity. And then their stock doesn't pay a dividend, and they do this all over again. And then they pay stock. They don't even really need to pay taxes because they buy, their yacht with debt. So they just really have to pay enough taxes to service all their debt, which is kind of what happened with this Bill Wong guy. He's just servicing debt. It's what happened to President Trump. People said he didn't pay taxes. He probably didn't. He probably used debt. He was the king of debt. He paid. That is a little bit of a misnomer too, because like even Jeff Bezos, he's paying city tax in D.C. He's paying sales taxes. He's paying property taxes, but Donald Trump was paying tons of property taxes. So even if they found some way to not pay federal income tax, they're paying all these other taxes. But the interesting thing about Warren with the wealth tax, although I'm against it precisely because we just don't, it's like Herman Cain had the 9, and God rest his soul, the 999 plan. I thought that was the cleverest thing, but the stupidest thing as well, because it's like, do we really want to give the government another way to tax us? And the idea was if it was 999, it would stimulate the economy. And I think he's right. But then somebody else will come in. It'd be like we're reading the Pesach story for Passover. And there was a generation who knew not Joseph. There was a Pharaoh who didn't know Joseph. If you know the story of Joseph in the Bible, he saved Egypt from famine. So he was exalted to a high position, sort of like the prime minister of all of Egypt, because he trusted God and basically saved all of the Israelites and all of the Hebrews and all of the Egyptians. So, but then, so many years later, the Israelites were in bondage, and the slavery that we remember in the redemption in Pesach. So it's a wonderful time where these kind of stories converge with finance. But all that being said, like, there will be a generation that knows not Herman Cain or knows not whoever, and they'll go, well, let's wealth tax everybody 10%. But if the idea is that they are sick of these billionaires, I guess they could just have a billionaire's tax. But that billionaire's tax, when I read the Elizabeth Warren proposal, it was like if you had an estate above 10 million, you had a 1% tax or something like that. So it was a way to get in, and then it'll be 5 million, and then it'll be 3 million. Then it'll be, so it's like the death tax, but it's easier to tax dead people. So to some way, this is kind of odd, rather than having a new tax, let's just rather tax dead people. But these dead people, though, do have smart estate planning attorneys, and they usually gift everything to trust or charity. The giving pledge is not merely dumb. It's so that they don't pay death taxes when they die. And they can figure out, they know the government is a poorly efficient means of distributing money. So they'd rather their charities. Bill Gates does that. There's charities that seek to help everything from vaccines to the blocking of the sun. Now they're talking about. So next up, Maria, your radio is off. Go ahead, Maria. Okay, we're going to take a short break. And when we return, we'll be back. This is Josh Jalinski, the financial quarterback. Don't touch that dial. Okay, we're live. This is Josh Jalinski, the financial quarterback, taking your calls on all matters financial. If you have a question on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one except the one that you do not ask. So, should there be a wealth tax? That's an interesting debate. Ernesto says no, but here's the one thing, though. The one truth in all of this is some people don't pay taxes that should. That's why I'm a big believer in the flat tax. If you just had like a 10 or 15% tax on everybody, and maybe you call that the 10% wealth tax, get rid of every tax, then you prevent these people from kind of gaming the system. But, we'll see. So Bill Wong, interesting thing. And it just ticks me off when people get hurt and blow up. I don't know how many regular people invested in Bill Wong, though. Is this thing? Is this just a bunch of rich people losing money? If so, that's fine. We don't need a bailout here. See, this is what happens with these low interest rate environment things. We have distortions in the system, and then the average person thinks, oh, it's Wall Street. Dude, Wall Street doesn't exist. The Wall Street that people think about, the Michael Douglas version of Wall Street, doesn't exist. Well, right now you have no commission trading on plenty of platforms. You have the rise of fiduciary investing. So like we're fiduciaries. So you pay us a fee, we help you with your money. We don't charge commissions on stock trades. We don't buy high commission REITs for our clients. We don't do that stuff. So there was a time where I guess Wall Street was screwing the average person. Like, I don't see that Bill Wong is Wall Street. I think that's like dumb hedge fund money that's usually used. It's like, in some ways, it's like the Madoff scandal. Madoff cost a lot of very wealthy people money. Like, so what? There's due diligence. You should have realized that you shouldn't have given your money to someone who actually held your money. So we have a third-party custodian. So your money's not with Josh Jalinski. Your money isn't with Wealth Quarterback. So some of this is, are we bailing out rich people again? Is this what this is leading us to? I don't know. It's like rich people shouldn't get unemployment checks. There's certain things that, we're like in a weird upside down world. So give us a call, 888-988-JOSH, 888-988-JOSH. Interesting news, Tesla delivered over 184,000 vehicles in Q1 2021, but the Model S and X production has dropped to 0. So I don't know what that means. Are they just trying to do the 3 in the Cybertruck? A lot of people, are you into the Cybertruck, Ernesto? Does that interest you?
I drive a 2005 Honda. I'm perfectly proud of that. I'm not going to be blowing money on that. That's
the way to riches, Ernesto. Keep it up. The way to wealth. Honda Civics that drive for 300,000 miles. And then you save that car payment in a savings plan on yourself. The way to poverty is to keep up with the Joneses. NFTs apparently are really big online. Everybody's talking about the non-fungible tokens. That seems like a wealth transfer tool for idiots. Although a lot of people are into it. So, there have been unstoppable trends before. So Biden has pledged that families earning less than $400,000 would not have their taxes raised. According to White House Press Secretary Jen Psaki, said this would apply to individual filers as well. Is there a scenario where individuals making less than $400,000 would get hit if they file taxes jointly? I think yes, because I don't think they're going to get the revenue that they seek. And then they're going to say, you know what, we have to lower the threshold to 300. Oh, we're going to lower the threshold to 200. Oh, we're going to lower the threshold to 100. Also, the price of lumber is up nearly 150% as another sign that inflation is here. Inflation is not something afar off. I guarantee you that in a year, the Fed will announce that we have rampant inflation. And that's probably what will derail the stock market in a year and a half, when they can't keep the ruse, folks. Inflation is already upon us. The price of lumber, the price of steel, the price of this, the price of that. So give us a call, folks, 888-988-JOSH. Also, we're on Facebook Live right now, fb.com/thefinancialquarterback. Check us out at youtube.com. All this is the other thing. Facebook, they what's up? And I'm on Instagram now. Ernesto is great, creating some great pictures on Instagram. Folks, I don't know if you know this, by the way, but Facebook is throttling people. We have like 2 people watching us. We have the most listened to show on WOR in the weekend, and we have 2 watchers on Facebook. So give us some eyeballs. The algorithm, these algorithms are just evil. So anyway, but
it used to be free.
It used to be free.
That's how we all grew up. That's how we all built our social media.
But now,
pages.
how many followers do you have on Instagram, Ernesto?
I think I have 40 some odd thousand.
40,000. Now, folks, go to Instagram, follow. What's our Instagram, Ernesto?
The Financial Quarterback, if I'm not, or is it The Financial QB? The
Financial QB on Instagram. We are The Financial Quarterback on Facebook. Give us a call, 888-988-JOSH. If you have any questions on your finances, call us 800-321-0710. 800-321-0710. Get you on with me right now. You get to ask me any question you want free. And we're providing chock full of good financial gems for free. We're not charging anything for this show. I'm going to start charging. So the interesting thing about social media is platforms rise. You might say, well, I never heard of TikTok before. TikTok, 62% of all users 29 and under are on TikTok. That's the next, Facebook. But why does that grow? Because it privileges its creators. So I think, Ernesto, you should be on TikTok.
I don't have good dance moves. I'm sorry.
You don't need good dance moves anymore, apparently. They're trying to get more creators on there. So there are people who have like 1.3 million followers on TikTok. They have like 2 followers on Facebook because the algorithm on Facebook is meant to have you pay for play. Google, the same thing. So interesting. So folks, go over to our YouTube page at The Financial Quarterback. Now, why is that important? What does that have to do with investing? You will see, what is there? Rumble is the YouTube alternative. Rumble, Parler is the Twitter alternative.
VidAffair is a new one coming out.
Twitter might suffer with Donald Trump not being on it any longer. He's saying he's starting a new one. I don't know what he's starting. So Parler was taken offline, then it was put online. Then you have, now here's why, as an investor, you want to go to where the content creators are getting monetized or they are getting rewarded for providing content. And that's where the investment will be. So what we're seeing is there's mega opportunity. Spotify just bought a Clubhouse alternative, which is interesting. So we're on Clubhouse. And for those of you who want a free Clubhouse invite, let me know. Schedule your no obligation review and I'll give you an exclusive Clubhouse invite at 888-988-JOSH. And then you have a question, Ernesto?
Do you think because engagement on Facebook is flat, because you just said it's a pay for play model, which is true. Do you think that it's going to affect their long-term stock value?
We own Facebook, so in the interest of full disclosure, Facebook will become sort of the next Google, that their method of delivery will be paying for people in the over 50 demographic. The coveted 35 to 55 demographic, which led to Instagram's rise, that may fall. And I think that's why Facebook will probably buy a Clubhouse or something, because they're privileging their creators. They'll get all these people hooked, and then Clubhouse will become a widget on Instagram so that Instagram can maintain its dominance in social media. Or Instagram might buy, TikTok for that matter. But I think TikTok may surpass. There was worries, would TikTok even exist? 6 months ago. I think TikTok will be rising now beyond Instagram. I think the young 35 to 55-year-old people will be flowing to TikTok. I didn't think how they could do it because nobody dances, but now they're doing TikTok videos and you're not dancing. That's why Instagram has Reels now. So it's very interesting. Now, what does this all have to do with money? When you're investing, you want to go, it's like Wayne Gretzky, you want to skate to where the puck is going. Now, people would say, well, why did you see opportunity in Facebook? Facebook's dying. Facebook's different. Facebook has traction among 50 and older people who will never go on Instagram. They find it confusing. They will never go on TikTok. They find it odd. And so their eyeballs are on watching their kids and grandkids, and there's huge amounts of money. So essentially, advertising will still be how Google and Facebook make their money. So I don't think they're going anywhere. And Zuckerberg is really trying to find what is the next coup? What is the next thing they're going to buy? You know, they had that Portal thing, which didn't take off. But if you look at Portal was really cool. Like you could get this thing, and as a grandparent, you could give your kid a Portal, and you felt like you were in the room with depth. Have you ever seen Portal, Ernesto?
I don't think so.
So Portal is a really cool thing, but it didn't take off because tech people who would buy it, like me, were like, I don't really want Facebook in my living room. You know, there wasn't that procedural trust. So they have to buy something like a Clubhouse, I think, or like a TikTok. Although, so we'll see. So what say you folks? Give us a call, 800-321-0710. If you have any question for me, we'll talk more about the Biden proposal to raise taxes. Also, how taxes were raised on you. Did you know that you had a tax hike if you were middle class under the Trump administration with the Secure Act? Now, tax rates were not raised, but the effective rate, and this is what's going to happen. Middle class wealth is going to be hurt. If you look at all these tax proposals, it's really to keep you a serf if you're middle class. If you have $1 million to invest, $2 million to invest, $5 million, $500,000, $100,000, $25,000, it's preventing you from being a reacher. Does that make sense? There are reachers and there are leechers. The tax code, as it appears to be, is benefiting more of those who leech and more of those who are on the top than the people in the middle. And so why isn't Biden's plan helping that? Because I'll reveal that, but Trump's plan hurt a lot of middle-class people, particularly with the death of the stretch IRA. It's called the Secure Act. If you want to know how it affects you, call us for a 45-minute Secure Act strategy session now. 888-988-JOSH, 888-988-JOSH. We'll be back after these messages.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.